Future trading involves risk and is not suitable for all investors. Content provided in this segment is meant for educational purposes and is not a solicitation to buy or sell commodities.
Hello, and welcome to Forecast Update Live, a video series from Ever.Ag Insights, where each month we gather to discuss our dairy market forecast. I'm your host, Jon Spainhour. We're joined today by Erica Maedke, Matt Gould, and Phil Plourd. To get us started, Erica, let's run through the highlights of this month's forecast compared to last month's.
This month, we are largely unchanged from last month. As we look at the markets, there's not a lot of new news to move our thinking. A little bit of smoothing in the nearby, but for the most part, we are holding steady.
Thanks, Erica. Each month, we ask our panelists to take either the bull side of the story or the bear side of the story. This month, Matt's taken the bear side of the story.
Yeah, thanks, John. Also, credit to the forecasting team for holding a forecast steady, given all the commotion, I guess we'll describe it that way, of what's going on here in the markets. Yeah, so the bear side of the story, John, I think is largely focused on domestic demand, which by many of our contacts' accounts, particularly those that are facing the food service sector, is quite poor. And we're seeing consumer sentiment deteriorate. We are seeing continued weakness, particularly at quick service restaurants. And the domestic demand environment is not firing on 8 cylinders, not firing on 4 cylinders, not firing on 2 cylinders. I mean, it's a struggle out there. And so that leaves us in a situation where our markets are very, very dependent on exports right now. And so then that leads to my second, the bearish argument, which is we are finally seeing a milk supply response begin to show up out of Europe. And the latest milk supply data is showing somewhat of a recovery. We have been able to balance our market, which has been troubled, I guess, by the domestic demand situation, by exporting. And the reason why we've been able to export is because our product has been on sale. Our butter and cheese and non-fat and dry whey now have been at discounts to the rest of the world. And that's helped us clear product. The reason why we've been at a discount to the rest of the world, at least one of them, is that European prices in particular have been high because milk has been tight there. Should that change, expect us to loosen pretty materially because, as I started kind of at the opening there, our domestic demand situation is not great.
Thanks, Matt. All right, Erica, you're on the bull side of the story today. Let us know what you're seeing out there.
It is interesting how we both look at two sides of the same coin. And in the same conversations we've had with people about how poor domestic demand has been, the flip side is the folks who are export facing are talking about the strength there. And John, I appreciate you getting up in the morning to follow GDT round by round and to see Southeast Asia step into GDT and a very strong event this week. So I think there is some underlying strength out there in the globe, not just because U.S. product is a deal, which it is, and the U.S. dollar is a bit weaker, making our products an even better deal. So we continue to see strength in the export market. And as we looked at the trade data that came out yesterday, cheese volume, I think, is the second highest ever, 109 million pounds of cheese leaving the country. Butter, very strong, 13.5 million pounds. Powders back in the ring around 140. So we're definitely moving product. I think the other thing to remember is there's often a delay. So when we start to see price gaps widen, that product doesn't always ship today. It may ship in 4 weeks, 6 weeks. So given the gaps that the U.S. has to the rest of the world, I think there's still a good volume yet to leave the country. And then to speak on the milk supply side of things, I think there's a risk here in the U.S. As we think about heat. And again, summer happens every year. We have heat waves, but it's going to be 80 in mid-May here in Green Bay. So this frozen tundra is not going to be so frozen. So just something to keep an eye on, that if we're looking at milk supplies growing 1.5%, if that's barely enough to keep up with the demand for the new facilities, what happens if we have additional heat this summer? So watch the seasonality. I think that could also play into the bullish case.
Erica, you, Phil, and Matt and I all spent a tremendous amount of time with the dairy industry over the course of the last few weeks, either at CheeseCon or at ADPI, another successful ADPI in my book. Phil, you're even in Florida right now at an IDFA conference. And I would say that during these times, there really has been quite a dichotomy of thought Erica, you pointed out those that are export facing, pretty supportive, looking at the U.S. prices too cheap. Those that are domestic facing certainly seem to be looking at domestic sales and saying these prices are way too high. The market's always going to fight its way out, but I just don't know that we've seen this kind of dichotomy in the market in quite a while. That's my take on things.
The battle lines are pretty clearly drawn.
Boy, I tell you what, you go from one conversation to the other and you just say, I don't know that those two have talked to each other. Well, along that line, every month we ask Phil to bring us his favorite look. Phil, take it away and let us know what you're bringing to us this month.
Yeah, this month is a strange one. So we've been talking about consumer sentiment faring poorly recently. The final April reading of the University of Michigan Consumer Sentiment Survey was just bad. It just showed us in a glum mood. But part of that survey is they asked consumers, what are your inflation expectations 1 year down the road? And in April, consumers told the University of Michigan that they expect to see inflation at 6.5% next year. April of 2026, 6.5% inflation. And, we have had those kind of numbers in the past few years, but the most recent number we had was 2.4%. And so consumers in a kind of not very inflationary environment are saying they expect a big jump in prices over the next year. And that alone is fascinating, but you think, well, how could that be? We just saw 2.4 and where you get to 6.5. And I think a few things are at work. First of all, I don't think the average consumer is chicken hawking the CPI report like we do. What's the inflation number? They may not know that the official number is 2.4%. And more importantly, I think that there's still some very visceral examples of high price items out there. It's like, well, sure, talk about 2.4% inflation, but why am I paying double for the price of eggs than I was a year ago? Why is my automobile insurance go up, up, and up all the time? And so I think that there's still some very visceral, tangible examples. And the third thing is that we did have massive inflation in 2021 into 2022, and I think that still stings. So I think we're kind of out of line with reality with that expectation. I think we are probably too fearful. But if we're wondering why sentiment stinks, a consumer who thinks that inflation is going to be triple a year from now from what it is today, that's a pretty big reason.
Thanks, Phil. Again, always just an interesting look. And also, I appreciate the use of the phrase chicken hawk. So you don't hear that every day.
Chicken hawking and eggs in the same bit.
Well done, sir. That'll do it for this month's episode of Forecast Update Live. Thank you to all our panelists. Thank you to everyone on the Ever.Ag Insights team for their work on the forecast. And thank you, the viewers, for tuning in. If you don't receive our forecast update and would like to subscribe, please reach out at insights@ever.ag. If you like this video, be sure to subscribe on our YouTube channel, give us a thumbs up, and share with a friend. We'll see you next month for another episode of Forecast Update Live.